It's on Friday, the 14th of July, 2023. A combination of slowing US inflation and a solid jobs market have led to risk-on sentiment over the course of this week, pushing equity markets higher to multi-month highs. And now that the earnings season is starting in earnest later today with the likes of JP Morgan, Wells Fargo, Citigroup, and also BlackRock showing their second quarter earnings, perhaps we can see a pause in these recent sharp ascents. When we look at the S&P 500, you can see that we've risen for 4 consecutive days and have now reached 4,517, which is a level last traded back in April of 2022. And it looks as if further upside is in store for the index, but short term we could see some profit taking basically ahead of the end of the week as investors cash in on their profits they make this week when going long. From a technical perspective, the next upside targets are around 4,539. That is a level going back to February of 2022. And then above the 4,550. But basically, provided we stay above the June and July, early July highs, that is between 4,458 and 4,447, the S&P 500 continues to look bullish and could even reach the 4,600 mark over the coming days and weeks. Moving on to the European markets, you can see here that the FTSE 100 has also recovered quite significantly from its lows, which took it nearly back to the March low at 7,204 by sliding to 7,228 on this daily financial bet. And now we are heading back up again towards this June to July downtrend line, which currently can be seen around 7,452. And it, together with the high seen on Thursday at 7,459, creates short-term resistance. And if it were to be taken out, the next upside target would be represented by this low here from the 9th of June low at 7,546, together with the red line here and also the downtrend going back to May and April of this year. And the red line being here, the 200-day simply moving average. So basically between 7,546 and 7,582, we've got pretty good resistance, but that would represent the next upside target area for the FTSE 100 if we were to manage to break through this 1 month downtrend line next week. Short-term support now comes in around the late June low at 7,401, and basically as long as we stay above there, further upside looks to be in store for us on this index. In Germany, the picture has been quite similar in that the German DAX 40 has slid through some key support, taking it back to levels last traded in March of this year, before basically bottoming out at this 15,455 low made just last week, and then rallying all the way back up again towards the early July high at 16,211. We have broken through this 1 month downtrend line, but haven't managed to take out the last reaction high yet, which is this 16,211 high. If we were to manage to do so, the next upside targets would be the May high at 16,333 and also the June high at 16,428. So these are the next possible upside targets. And it means that even though we briefly broke through this key support area, what we probably saw over the last few weeks is just an ABC zigzag Elliott wave correction in a longer term uptrend. And it could imply that we can see a new all-time record high being made in the DAX 40 over the next few days and weeks. And this view would only be changed if we were to fall through and close below the 15,455 low made on the 7th of July. The US dollar has fallen extremely sharply over the last few days on that softer US consumer price index reading, and also on softer PPI, that's producer price inflation, out of the US, basically indicating that the Fed is less likely to continue to hike rates aggressively, and that a soft landing in the US remains quite possible. And if you look at the inverse of the US dollar index, for example, the euro dollar here, the euro making up 57.6% of the US dollar basket, you can see here that euro dollar has risen to a 17-month high. As I say, on that producer price index, which came out yesterday and which edged up 0.1% month on month in June of 2023, following an upwardly revised 0.4% fall in May. And it came in below a forecast of 0.2%. That is a rise for June. So here we've now seen, as you can see here, 6 consecutive days of higher prices for euro dollar, taking us today's high at 112.43. And if I go back, you can see here we're trading at levels last seen in February of 2022. And the next upside target would be the mid-February low here at 112.80. Around 40 pips above current levels. But it is quite possible that today, on Friday of this week, the end of the week, we may see some profit taking on these euro dollar longs, and therefore we could actually stall here. Now, from a technical perspective, there is some slight support around 111.20, and then below there we've got 110.95, the April high, which should offer really good support in case of a minor retracement lower being seen perhaps next week. The British pound has also benefited from the much weaker US dollar, and it has risen to a multi-month high, I should be saying. If you look at the weekly chart here, taking us back to levels last traded in April of 2022, and also above the red line now, the 200-week simple moving average at 128.87. And this is the first time this has happened since April of 2022, and could indicate that much further upside is in store for the British pound against the US dollar over the coming month. And you can see here that we've now risen to 131.42 after having seen 6 consecutive days of a stronger pound against a weaker US dollar. Now here there is minor psychological support around the psychological 130 mark, and then there is pretty decent support also taking us back to the June high at 128.48. But right now, it looks likely that even if we were to stall short term on profit taking, that any minor retracement would probably end above the 130 area, with further upside then being seen in the coming days. The story is quite similar with regards to the US dollar versus the Japanese yen. As you can see here, the US dollar has declined very sharply again for 6 days in a row on that softening US inflationary picture. And you can see here we nearly reached the red line, the 200-day simple moving average at 137.04 by falling to 137 yen and 25 cents earlier this morning, before starting to form this hammer formation, which if we were to close on a New York closing basis here today in that same sort of pattern, could mean that short term at least we found an interim bottom now at 137.25, and that we could perhaps recover slightly towards the psychological 140 area. But above that, we've also got some pretty good resistance at the May high at 140.93. So it's likely only going to be a short-term pause in this new very sharp downtrend. And you can also see the March to July uptrend line, which now, because of inverse polarity, could next week act as resistance around the 139.42 mark or so. So that is also something to be remembered. The weaker US dollar has had an impact on commodities, a lot of these surging higher. And when we look at the daily financial bet of the oil, first of all, the gold price, you can see here that gold has actually benefited from the weaker dollar and has surged higher, taking us to the current high we've seen in July at $1,963 per troy ounce. And very close to the last reaction high here, that was the mid-June high at $1,968. So this wouldn't have to be taken out for us to then extend these gains next week, perhaps towards the June high at $1,983. But be aware there is a pretty strong resistance area between the mid-April lows at $1,970 and that high I just mentioned, the June high at $1,983, which may cap any further upside, at least short term next week. And today we could also see some profit taking of longs over the last few days into the weekend as investors take money off the table on this bullish short-term gold trend. Moving on to crude oil, what we've seen here is the third, or at least we're on track now for the third consecutive week of higher prices to be seen with regards to the oil price. And this was on the back of OPEC Plus basically cutting output by nearly 5.2 million barrels a day. Saudi Arabia voluntarily cutting its output by 1 million barrels a day and saying that it would extend that output cut to the end of August. And it has also been joined by Russia, which is also cutting its output by 500,000 barrels a day, all of which has led to supply worries and therefore to this upsurge in the price of oil, taking the oil price on WTI to the red line here, the 200-day simple moving average at $77.02. There we may see short-term stalling of this uptrend simply because the 200-day simply moving average quite often does act as a resistance area, as you can see here, did so very well in April of this year. Now, I don't expect a sell-off to emerge like it did back in April this time around. Perhaps we will see a short-term retracement, but because we've got some really, really good support area now, basically we've been trading in a sideways trading range since mid-May of this year, and now that we've broken above this major resistance between $72.70 and $74.70 because of inverse polarity, this resistance area is now going to be a support area, and therefore I would expect it to hold, and any retracement towards that area could be used as an entry level to actually buy into this new uptrend in the price of oil, because once we take out the 200-day simple moving average, ideally on 2 consecutive daily closes, we could then be heading back up again towards the psychological $80 mark and also head back up again towards the March and April highs. And these are seen between basically $80.98 and $83.40. And I'd like to finish up on wheat prices on charting the markets today. We saw that the price of wheat actually declined briefly below its late June low at $6.41 and took us down to $6.27. Short term, we seem to be bouncing off that level. But as you can see here, we've really topped out in June at $7.70, have fallen through this uptrend line, and then traded sideways to down, which took us back down to 627. So I expect further downside to be seen, provided we stay below the early July high at $6.82. And that would mean that if we were to fall through the $6.27 low, we would be heading towards the early June low at $6.20. And then below there, we've got the psychological $6 mark, which still remains in focus for the price of Chicago wheat, provided we stay below $6.82 on a daily chart closing basis. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is AxelR_IG.